Okay, I'd like to welcome everyone to the inaugural Market Matters webinar. I've got Shawn Hickman here with me. Welcome, Shawn.
Thank you. Welcome, Nick.
Okay, Shawn, so yield or growth is the topic you've chosen. Why have you chosen that?
Yield or growth is very easy, Nick. At the end of the day, we're in an unprecedented low interest rate environment. We've been coming here slowly but surely over the last 5 or 6 years, and there will be an inflection point. And I personally think that inflection point is growing faster and faster, or getting closer faster and faster. So we've got to prepare for that change in trend. We've got to prepare to get off that yield play. Everyone's trying to buy interest rate bearing stocks. Everyone's chasing stocks that are paying high dividends. And when everyone's doing the same thing, you've got to be careful, you might be in the wrong place.
Okay, awesome.
And the other thing I'd like to add as well, Nick, is the fact that we're doing a webinar is really, really exciting because it gives us a scalable way that we can present to people our thoughts quickly, live, within some interaction. So hopefully we can embrace these moving forward and do them more and more regularly.
And one thing I would say, there'll be some time for some questions at the end. Shawn's happy to take any questions you have, so feel free to type them on the screen throughout the presentation if something triggers a thought process, and we will take them at the end.
Just keep them simple, please.
Okay, so just a general bit of housekeeping. You'll need to use sound on your PC, and headphones are advised for a clearer sound. You can ask questions on the toolbar, which you'll see. You can type questions in. As I said, we'll take them at the end, or even ad hoc, depending on the type of question. And the last thing is this thing will be recorded today, and we will be making a recorded version available to people over the next week. Okay, so just some compliance. Disclaimer, the information in this presentation is of general education nature only. It does not take into account the investment objectives, financial situations, or needs of any individual investor. Before making any investment decision, we recommend that you consult a professional advisor. Okay, let's kick things off. Shawn, where do you think the ASX is going in 2015? Obviously, at the moment, we've had a nice run up, a bit of consolidation over the last week. Where to from here?
Okay, Nick, well, that's obviously the big question. We all knew the answer to that. Specifically, we wouldn't have to go to work, but I still would because I love the markets and I find them really passionately enjoyable. I think the market's doing exactly what I've been saying over the last few weeks. I think it's just having that scenario. We're having a rest. We've had a massive 730-point rally over the last few weeks, and over the last 2 weeks we're pulling back. This pullback, in my opinion, is a pullback to buy. I think we'll get a little bit lower. Today, interestingly, the market's struggling big time. Even though the Dow was up 138 points last night, the market can't get up. It tells you there's still more some profit taking out there. There's still some selling in our market, especially the iron ore space again today. Much under 5,800 towards 5,750, I'm a buyer. Yep. I think from there the market will push up and make probably the high for the year, maybe 6,100, 6,200. I'm not going to guess quite how far it's going to go. But at that level, I will be going probably 50% to cash, depending on how it does it. So my roadmap is very simple. Buy the market around 57.50, give or take 25, give or take 50 points. Run the market up toward the low 6,000 mark. Take a lot of profit, sit back in cash, and see what happens. It could be a classic case of sell in May and go away. Let's wait and see.
If you're a betting man, where would you put the index at the end of the year?
Nick, well, everyone likes to make that comment, and very few people get it right. If I was to say at the end of the year, people might not want to hear this, I would say about 5,500, 5,600.
Okay, awesome. Okay, so next slide, overseas stocks and funds. Obviously you've got that currency that can really affect returns there. In your opinion, are they a good option?
They've certainly got their place, and there's lots and lots of them now. We've got plenty of opportunities to invest overseas. Do I think that the overseas markets per se will outperform Australia? Yes, I do. On two fronts. We are probably going into a recession, or we are going to struggle to keep out of a recession. That's why our interest rates are going down. They're factored to go well under 2% in the next year. That's not because our economy is strong. We've got massive problems. We're fundamentally dependent on China. Where China goes from here, it's going to slow down. How much it slows down, none of us know. We can all guess. Reading between the lines of their stats is a very, very tricky one. But overall, I think our market comes down, and with that will be the Australian dollar. The Australian dollar could easily come down under 70 cents in the next year. People have been talking about that for a long time, but it is slowly but surely eventuating. So I think the US market's going to have a big pullback this year, as I've been saying for a while, maybe 15%. If that happens and people do panic and sell some of those US funds, it might be a good time to get on board, because as long as you're buying a fund overseas that gives you the advantage of a falling Australian dollar, then it's a very, very sensible place to be.
Okay, and we've got the S&P chart there. You've been talking about rising interest rates in the US. Do you think that would be the catalyst for this correction you're talking about, or is it just going to be some bad news, it snowballs, and obviously we see the market come back?
I've got to think it will be the rising interest rates, Nick. That seems to be the dominant factor at the moment. Of course, there are always black swan events out there. Greece, who knows what's going to happen to Greece? It seems a bit of a foregone conclusion. It will drop out of the euro, etc., etc. But there's nothing new there. Likewise, there's nothing new in the fact that interest rates are going up in America. We all know they are, but just look at that chart. You can see it in front of you. You can see the fact that since the mid-2011, the S&P has gone from 1,075 up to 2120. That's a massive, massive rally. Hasn't quite doubled. For it to pull back, what I'm saying, a 15% pullback from here is absolutely nothing. But it makes a big difference to your investment returns if you can buy the market 15% cheaper.
Okay. So next slide, Magellan. Obviously a continuation for our overseas stocks and funds, a good option. Now, you touched on a few options there before and ways where you think the overseas indices are going. Now, Magellan had a dream run. We have had a lot of potential buys on it, but I've always wanted to buy it a little bit lower since we've had Market Matters going for about a couple of years now. Now, where do you sit at the moment on it? Is it something that you'd look to buy if it pulled back a little bit further, or you think it's too expensive?
No, I actually think if you look at the way I've labelled that chart there, I actually think Magellan in this area is a buy. I think you'll get best part of a 10% rally out of Magellan from here up towards $22. I did say a few weeks ago, excuse me, up around 21 that I thought it would just sell for a pullback. I now think we're going to get a little bit further on towards 22. But that will tie in with the S&P, and that will probably tie in with the tops I'm looking for in the market.
Okay, great. So the next topic we want to focus on is, the chase for yield. It's obviously gone on for quite some time now. We saw a cut recently. We probably will see another cut in most people's expectations this year. When do you think this will all end? Because I think what the key is to people get set before it does end.
It's a very hard one with the chase to yield to end. People find it very, very hard, including myself, to start selling some of their very profitable bank shares. Look at CBA. She's had an enormous rally, $50, $60 not that long ago, $40. Now it got up to almost 94 recently. It's paid a great dividend. It's still trading well above $90, which means everyone's sitting on capital gains situations as well, which means people are very reticent to sell. So my gut feel is that these banks are going to have a decent pullback this year. CBA, I think, will have a $10 pullback this year, if not a bit more. I wouldn't be surprised to see a bit of a push up into maybe an April rate cut or anticipation of a rate cut, and that's when I will be getting off that trend. And I certainly won't be taking that trend for granted anymore.
Okay, awesome. And you did touch on interest rates before, but here's a chart of US interest rates. You're saying they have bottomed. You think, they'll probably head up from here. That's what most people are expecting based on the employment number we had the other night.
Yeah, that's no big surprise. If you look at that chart, let's have a look what's happened. It hasn't, over the last month, interest rates in the US on the 10-year bonds have gone up by about 40%. So interest rates have gone up in the US by 40%. That's quite a big move in the rates. So if interest rates are going up in the States, it means for us to cut rates here, our economy's got to get very bad, which it might. So I think one more rate cut, that could be the end of the yield chase, could be the time to really start diversifying a bit more towards growth.
Okay,
hence our topic.
Awesome. Okay, the next couple of slides is Telstra the best telco moving forward? First of all, we've got Telstra here. Recent acquisition around that 625 mark, around where it is now. We've had the dividend. What are your thoughts on it from here?
Well, people that have been reading my reports closely will know that I'm actually losing a bit of patience with Telstra going forward. I wouldn't be surprised to see myself sell Telstra in the next few days or weeks. Keep a close eye out for alerts. I think it isn't the best telco now going forward, and that the pullback in Telstra, even though it's ex-dividend, it has been a bit underwhelming compared to the pullback in the other telcos I prefer. So I do believe that Telstra is running out of legs, and it's time to lock a bit in. If I was trading just Telstra right here, right now, I actually think it's a buy.
Okay, and the next one is Vocus, one that you've talked about quite a lot like the growth element of the stock. Is there a level where you look to buy this stock? What are you thinking at the moment?
Well, Vocus is very, very much my flavour when it comes to the whole growth scenario in the Telstra space, or the telco space, I should say. And I am looking very closely at the stock. Again, watch out for the alerts. This is my favourite telco stock at the moment. It's come back a long way. Look, it's come back over $1. As I said before, that's more than what Telstra's come back. So I can well see myself putting some of my Telstra money to work in Vocus in the near future. Watch out for the alerts.
Okay, awesome. Okay, the next topic is when will I buy iron ore and oil stocks? We had a successful trade in Woodside last December. You've been an active trader of Fortescue over the last 18 months, quite successfully, I might add. You're saying you don't like these stocks for various reasons. When would you look to buy? Is there a certain price, a lot of stocks in this space that you look to enter in?
It's not hard, Nick, when you look at that chart to see why I don't like the iron ore stocks. Look at the price. We've had a massive, massive decline in the iron ore price, and that could be ongoing. We can't control the destiny of these stocks. Fortescue Mining is a very, very healthy company in the way it runs and operates its company, but it's dependent on the price of iron ore. Iron ore is falling. So I think you have to be very, very careful buying iron ore stocks. However, I also like to trade around the edges, and I stress the word trade, not invest. And I will be putting my hand up to buy some call options on Fortescue around that 180 level, looking for a dollar rally. And I will not be married to it. I will get out like we did with Woodside in December. So I say, if we have panic down towards 180 in Fortescue, look out for the alerts. I'll be buying some call options. It's due for a dollar bounce. But in terms of investment, I have no interest.
Okay. In terms of the call options, not all of our subscribers have access to options. Would that just be, buy the underlying stock and just follow your alerts on the option?
Yeah, of course. People can do that. People can do that. Hasn't got quite the same leverage. What concerns me about buying it's a very good question actually, Nick. What concerns me about buying the stock is you can lose all of it. It can go from $1.80 to $1 very, very quickly if iron ore just collapses. Whereas if I pay a small amount of money to buy an option, all I can lose is that small amount of money.
Okay. Yeah.
So I'm being a bit more conservative even though I'm going the leverage way.
Okay. Awesome. Okay. And the next one is the oil. The oil price. We've seen it stabilise a little bit after dropping below 50. Is that a dead cat bounce in your opinion? Do you think oil's going lower?
Yes and yes. Is that a dead cat bounce? Well, it hasn't really bounced, Nick. I mean, look, it's halved and it's still here. It's hardly a bounce. Oil, in my opinion, will be under 40 sometime in the relatively near future. When it does that, if it's that's into April, great, probably coincide with a really good bounce in quite a few stocks, and I might be looking to buy a few call options on the oil stocks as well. But overall, from an investment point of view, I am not buying oil stocks. Again, they are not controlling their own destiny. Saudi Arabia is.
Okay, awesome. Okay, so the next topic is, what does the aging population mean for healthcare stocks? Obviously, we've got a lot of baby boomers here in Australia, quite a top-heavy population pyramid. A lot of these stocks in this space you could argue are expensive, but they keep going up. So in terms of the aging population, what does it mean for a lot of these stocks? Are they buyers here? You buy them at lower levels? What's Shawn Hickman's opinion?
Well, that's a very good question or point about being expensive. Anyone that reads the newspapers will know that Commonwealth Bank has been very expensive for quite a few years. But hey, she keeps on going up. And it's the same thing with the healthcare space. We all know it's an aging population, and any stock doing the right thing in this area, and we've got a few in Australia, are doing very, very well. So yes, they are expensive. Yes, they are on high PEs. Ramsay, ResMed, CSL, they're all very, very healthy stocks. But they are a bit expensive, and so you can afford to be a little bit fussy, but I've missed out doing that. I don't own one at the moment. I wish I did. When I look at this, I look at the fact that I think our market's getting ready for a bit more of a run. I'm going to say, okay, I'm going to be a bit more patient. We will get a pullback in Ramsay, for example, at some stage this year of around $6 in my opinion. When we do, even if it's back from 76 to 70, then I'll buy it from a risk-reward point of view. But these are stocks I like very, very much. It's a matter of risk-reward. They're due for a rest. They are great stocks.
Okay, and ResMed, you've had that in your weekend report for a long time, haven't had too much activity in the stock. What are you seeing there? That's also had a dream run recently.
It has, and I really did think 2 weeks ago, Nick, that we'd be able to buy the stock underneath $8. It threatened to make me happy, and bang, it's gone up again. So I'm just watching it now from a risk-reward point of view. I'm just being a bit cautious here. These stocks are getting very, very rich. They are being chased to extreme levels, but they're where you want to be. They are growth stocks. They're looking good. So I like the stock. It's a bit rich here. I'm being a bit patient.
Okay, awesome. Okay, with the next topic, it's, with the NASDAQ hitting records, which local technology companies look good? Now, we don't have a heap of technology companies on the ASX like over in the US, with the NASDAQ hit over 5,000 recently. What are your favourites in this space, and, would you buy any of them?
Well, we've got a couple here. Yeah, unfortunately, we haven't got an Apple or a Google. I'm sure the government would be very happy if we did, because it would make a big difference to our balance of payments, but we haven't. So we've got some smaller versions, but they're very good companies as well. So I look at Seek here. I think Seek technically will come back towards $15. I will be a very, very keen buyer at that area. So right here, right now, I'm neutral to negative Seek. I'm not actually going short, because I think overall it's a very good company and I like it. But I wouldn't be buying it until it was under $15.50, and I think that opportunity will come. So watch that space.
Okay, and the other one you've got here is car sales. Looks relatively neutral on the charts. Been trading sideways for quite some time. Is that one that you're interested in as well?
Well, it's another one that I've said for a while will come back towards $9, and it's already dropped $2.30 from the high. So I do think it will come back towards $9. And again, I'll evaluate that at the time, depending on where the other stocks are in the same space. So I do prefer Seek to car sales, but let's wait and see how they all eventuate at the time. But it is a tricky space because we haven't got a lot of good choice.
Okay. Okay, and the next topic is major supermarkets. How long do we avoid them? You came out last year and you said, stay away from Woolworths when it was in the mid-30s. We saw that number recently, pretty abysmal. It's actually dropped below 30. People are no longer calling it a blue chip stock. What's your opinion on this stock? Do you still think it's coming back towards 25?
Well, you can see it there on the chart. I think you'll see Woolworths get under 25 in the next few years. I see no reason to own it. From a risk-reward point of view, people are looking at Woolworths and they're still remembering the glory days. It's going to have to fight hard now. Its margins are going to be compressed, and it's a tricky place to be. The next chart is going to show you what happened to Tesco's. So at the moment, I think I wouldn't necessarily go short. We've already dropped $10. Let's think about that. It's already dropped 25%. I think it's dropped 15% since I said sell it. So from here, risk-reward-wise, I'm only saying it's got another $4 or $5 to go after dropping 10. I wouldn't be going short as a trader, but I certainly wouldn't be looking to buy this stock until it got much closer to $25.
Okay. And you just hinted on the next slide before there is Tesco. You look for a lot of overseas indicators to do your analysis here. What are you seeing on that chart?
Okay, well, it was the Tesco's and Sainsbury's charts. It was the charts of the English supermarkets that really got me focusing on Woolworths. Look what happened there. Look what happened to Tesco's when they walked into the same sort of tsunami problems of competition, margin contraction. The stock fell almost 70%. Now, I'm not saying that Woolworths will fall 70%, but I do think from a risk-reward point of view, there are better places to go. And if you really, really want to own a supermarket, Wesfarmers is a better place to go. I think it's a better company. There's got a bit of diversity there. It's holding up much better. But personally, I wouldn't be all over it. It's all about timing. The timing is so important. I would just be careful.
Okay, the next topic. Is the retail sector the next big thing? Towards the end of last year, we were looking for a bit of a trade / investment in the retail space. Didn't quite go our way. You do watch this area quite closely. So, what is your current perspective on it? You did say to a client the other day that Myer's a real flip a coin job here, and lucky you did sell some. But what are you seeing here?
Well, I think you're being very kind to our selection last year. We couldn't have got it worse. We had to go at Myer, and we were totally wrong. And David Jones was taken over, and Harvey Norman's broken out. So when you look at that chart there, that tells me that the retail sector is looking very, very interesting. With low interest rates, the government is going to try and make people spend money. And to me, it looks like they're going to be successful. Then the hardest thing from there is to say, okay, if the people are going to start spending money, where are they going to spend it? And then it gets a lot harder because we've got a whole change to retail, a whole change. We've got people shopping online, but everyone knows that now. So you've got to pick your way through the space very, very carefully. And I think that the one slide I have put in there is Harvey Norman, because that's clearly breaking out. It's in resistance. You could buy that right here, right now. I personally wouldn't. I'd be watching it. So unfortunately, I think the space looks great, but I haven't got a clearly defined trade on any stocks in that space at the moment, which is not that exciting, I know, but this does happen sometimes. But I think it's worth looking at that space very closely because the whole retail sector does look interesting.
Do you think rate cuts will translate to people spending more? It's too hard to say.
Well, it's not at the moment. I think I read a stat today in the Financial Review that between 75 and 80% of people that benefited from the rate cut have just simply left their repayments the same and are paying down extra debt, which is interesting. It means the banks, by definition, are getting more and more and more insulated about any future property pullback, which is probably not going to happen. So at the end of the day, if the banks are benefiting because it makes them safer, people are not yet spending money. Unlike my wife spends money very well.
Okay, so what we're going to finish here with is your clearest bullish and bearish stocks at present. Now, first of all, we've got Challenger, reported really well. It was up around, held its dividend the other day. What are you seeing there? Could you still buy it here?
Well, I have recently. I mean, it's gone ex-dividend too, so the stock looks very, very healthy, considering it's just paid a 15 cents dividend. I like the stock. I think it will go back towards $59 over the coming year. I like its whole business model. It benefits from people getting older as well, people having to put away for their retirement. Perfect place to be. A little bit of concerns by some people about what their investments are, but overall, I like the business model. I love the chart. Technically, the chart looks fantastic. I'm a buyer of any weakness in the stock. I like it very much. Okay. One of my favorite too, and I recently purchased it.
Okay, awesome. Okay, the next one's Commonwealth Bank. I guess most people hold Commonwealth Bank nowadays. It's up around over $90. Was at all-time highs recently. It's come back a little bit. What are you seeing here? You've liked your holdings recently.
Okay, well, overall, Nick, I like my holdings slightly to put it into Challenger because I am looking to spread my investments a little bit as I'm starting to look for some growth and pure yield. But this stock looks fantastic. Now, anyone that looked at this morning's note and read those stats will know that stocks that are making new all-time highs are good stocks and you should buy more or not sell them or hold on to them. So I sold a little bit, but I sold a very small bit of my Commonwealth Bank. I believe this stock will go up a lot more. But look, between 2010 and 2011, it had an $18 pullback and it had a rest. It's a very healthy rest in the scheme of things. The stock has well over doubled in the last 3 or 4 years. So all I would say to people is be prepared for a $10, $15 pullback in the next year or two. It doesn't matter. Buy some more when it happens. So I'm a buyer of a Commonwealth Bank into weakness. I think it's a fabulous stock. I think it's going a lot higher.
Okay, awesome. Okay, and the next one is a stock that I'm assuming you're bearish on, based on the red on the chart. Now, traded this very successfully from November to January. Also traded it very successfully a year ago. You seem to pick this one quite well. What are you seeing here? It looks like it's broken down. Yeah, I mean, we are due to get Newcrest wrong, but until that point in time, I'm going to stick with the chart. The chart is working so well, and the fundamentals around gold concern me. Today, Newcrest Mining's broken down. I think Newcrest Mining now goes back towards $6, and I will not be buying it until it gets down towards $6 from where I would be interested. So technically, it's an awful breakdown. I can see the stock falling a long way. I can see gold easily falling $100 from here. If interest rates are going up in America, you get no money to hold gold. In fact, you've got to pay to store gold, whereas you're going to get higher and higher rates in the bank. We all know you're getting higher rates when you hold some of our banking shares. So I think Newcrest Mining's in trouble. Even though it's improving itself as an operational company, I think it's going down. I couldn't touch it, and I'm sorry. I know a lot of our readers like to buy gold stocks. I've got a feeling a few of them didn't take profit when we did, but I think the stock's going down. Okay, and just quickly on this, the gold price, you watched that relatively closely, broke down the other night, as you highlighted in the morning report on Monday. Where do you think the spot price is going? Do you think we're going to see it continue to contract, or just putter away and trade sideways? Okay, that's a good question that's just come in. I actually think that gold itself, it's actually still got a buy signal for me, and that's one of the reasons why I wouldn't consider going short Newcrest. But I think that buy signal is about to be broken very soon. Just the fundamentals are dominating the story with gold for me. I can't see any reason to buy it because it's caught in the wrong vortex. There's no inflation around the world, no inflation whatsoever, and rates are ticking up in America. Why would you buy gold? So if that's the case, Newcrest could struggle. Okay, awesome. Okay, and the next stock that you're also bearish on is BHP. BHP had a great bounce recently. The chart you've got here is the BHP US on ADR chart. I think it'd be good for subscribers and other people watching if you could explain how you use that chart to, formulate your view on BHP here on the ASX.
Okay, that's a great question, Nick. My favorite technical way of trading the market, and we'll look at both when we look at this chart, because I know most people look at BHP very, very closely. So my favorite technical way of trading is what I call a false breakout. There are different ways to call it. Now, if you look at BHP there, in US dollar terms, it had a false breakout to 104.59. Now, if we go back and look at the Newcrest mining chart, it had an identical move. It moved up to 43.71, breaking out of that normal distribution between 40.50 and 16.55. It came back in. That gives me, mathematically, an 85% chance of moving down to the 16.55 level there for Newcrest. And then if we go back to the BHP chart, I stress, in US dollar terms, we've got the false breakout to 104.59. That tells me that BHP is going back down to $30 in US dollars. Now, I keep stressing that. It's in US dollars. BHP trades a lot overseas, trades in the UK, it trades in the US. So every morning we know where BHP is likely to open because it was trading at 8 o'clock in the morning. It doesn't really stop trading. It's a true international stock, the way of the future. All stocks will trade 24 hours a day before we know it. So, what I'm looking for now is I think it'll go down. The biggest key is how far does it go down with relation to the Aussie dollar. The Australian dollar is at 60 cents. I'm only calling it down to 25 at 30. So that's not that much lower in Aussie dollar terms. So keep a close eye on the two there, I'm afraid. But I can't buy BHP. I don't like the oil price, and I really don't like the iron ore price.
Okay, so what we're now going to do is a bit of Q&A. We've got a few questions here from subscribers. Varying questions, I must say. First of all, Shawn, just want to kick things off. Now, you don't have charts at your disposal here, so if your answer's not thorough enough, you could always follow it up in the reports. But just your updated perspective on ANZ, Westpac, and NAB. NAB being the one that you own at the moment. Okay,
well, I think at the end of the day, Nick, that's one question. I'm sorry. The banks are all going to go ex-dividend in May. April is the strongest month for the banks historically. CBA for the last 16 years has never been down in April. I don't think it will be down this April. I think all the three banks will run up into April. They'll run up or trying to run up into their dividends. So I would stay long them and be looking to lighten off, maybe even be before the dividend. But I think they will run up into April. So I would stay long those banks.
Okay, I've got a question here on dividends. Now, a subscriber is asking, Shawn, could you explain the 45-day holding period for dividends with franking credits attached? Does it apply if the stock is held for 12 months plus the stock and sold within 45 days of the dividend being received?
Okay, I've got to be very careful what I say here, Nick. I don't really like answering accounting-style questions because I'm not a qualified accountant.
Yeah.
Simply, when you buy a stock, doesn't matter when you buy it to when you sell it, any dividends in between the two. You need to own the stock for 47 days, really. It's 45 plus the day you buy plus the day you sell. So if you've owned the stock for 47 days, from the day you buy to the day you sell, you get to keep the franking credits. So if you buy it 2 years ago, you keep all those franking credits. That's a no-brainer. So, but I would always clarify that. Please clarify that with your accountant and work out what suits you best.
Okay, the next one here is in relation to gold. Have someone asking you, interesting that you say gold down $100 today when just a few weeks ago your alerts were saying gold would go to $1,400. When will you make a definite decision? One thing I would say here is, Regis did go from $1.40 to $2 as expected. Same with Newcrest, $8.90 to $14. But, when will you make a definite decision there, Shawn?
No, well, I think that, I'm not sure who that was from. Who's that from?
Paul.
Paul. Okay, Paul. I did clarify earlier when I said that I've actually still got a technical buy signal on gold. So if you look at the weekend report, you'll see that I've still got a technical buy signal on gold, but we went bearish Regis only in the last 24 to 48 hours, and we've gone bearish Newcrest mining today by closing or trading underneath 1250. However, I have said for the last few weeks that there's no reason to own Newcrest or Regis, and I did have that discrepancy where Newcrest and Regis both hit our targets and we sold all our stock, and yet the gold market itself fell well short of my 1400 target. So that's what I'm saying. I've actually still got a buy signal for gold, but I'm overriding it because the stocks have broken down and also because the fundamentals don't look good. And when you invest, when you trade, it's like looking at a jigsaw puzzle. When you've got all the pieces, it's too late. You've got to put the pieces together and act before you have the puzzle complete. And in this particular case, the pieces have come together. 2 or 3 weeks ago, we had a situation where I couldn't put a trade on, but I most definitely said get out, and we sold all of our positions a month or 2 ago. And now those pieces have come together to say to me, gold's breaking down. Gold stocks are actually leading the way.
Okay, next question is, why do you use monthly charts in your trading? So I guess he's probably referring to, why do you use monthly charts in with daily charts, etc.?
Okay, very, very good question. I've had a few people ask me that before when I've spoken to people, which I quite like to do is speak to subscribers. I use the chart that I find clearest. So sometimes it's a daily, sometimes it's a weekly, sometimes it's a monthly. When it comes down to things like CBA, when it comes down to Woolworths, I use the quarterly because it's just a clearer chart for me. I'm just looking for charts that are clear. 80% of charts look like a spider that's walked through an inkwell and gone across a page. If I don't understand the chart, I move on to the next one. So I'm looking for risk reward. Also, another reason why I use weekly and monthly charts is it tends to iron out the factors of the dividends. When a dividend's paid by a stock, obviously the stock generally falls, and that can make blips. The longer dated charts take those blips out.
Okay, awesome. So next one is one that you've talked about recently that I remember you said in the report the risk reward wasn't quite there for you, but it has gone up since. You have traded it in the past. QBE, what are your thoughts on it at the moment? I don't know, where is it, $13, $14 at the moment? I haven't checked in the last couple of days.
QBE is having a bad day today. It's a very volatile stock. It's had a piece of me a few years ago, unfortunately, one of the few stocks it has. It's a stock that should benefit from interest rates in the US going up, and it should benefit from an Australian dollar going down. The third, there are a few more components there. It should also have a situation where people don't fully trust the company, but the trust is coming back. And fourthly, I think I said 3 points, sorry, fourthly, the margins in the insurance space do concern me. So I no longer own IAG. I no longer own Suncorp. Those shares to me look a bit rich. So with QBE, if I was to buy an insurance stock at the moment, it's probably the one I'd buy, but I wouldn't go into it full size. I'd go into it a bit smaller, but it has a lot of fundamentals pointing in the right direction.
Okay, next question. I think this is a fantastic question, so thanks for asking this, Dimitri. Shawn, what timescale are you using when saying medium, long-term in your portfolio? Because you've obviously got them split in Hickman's positions.
Okay, that's a bit of a, I don't want to say, Dimitri, it's a grey area, but when I say medium, I tend to mean 3 months, longer term, like my CBA holding. I expect to own CBA for the next 2 or 3 years. So I would say probably 3 to 4 months or 2 to 3 years. But it is a bit grey, and I'm a fluid investor, so I will change my mind at times. You've got to be open-minded. You can't just say, I'm owning that stock, I'm never getting out. Otherwise, you could be owning iron ore stocks, and they've all fallen by 85%. So keep open-minded. But to answer your question, I would say 3 or 4 months for medium, short-term, a bit longer for the medium outright, and then long-term is years.
Okay, so the next one is, what is your short list for ASX-listed growth stocks, particularly those with overseas revenue receipts? Now, I guess Ansell springs to mind there. You did trade that quite successfully, maybe a bit early on the sell. It's gone up since, but what is your short list of those stocks?
There are a few stocks there. I mean, Crown is one that comes to mind. Technically, Crown looks quite interesting. It's a very, very volatile stock, but that volatility can be utilised because you can buy the really bad days. Like today, I think the stock's down 4%. So when we have stocks that get really, really hammered and they're in that spectrum of interest, then you can pick them up. Yes, Ansell's gone a lot further than I thought, Nick, and I wish I still had it. And that's starting to get my radar again for a pullback. Amcor's another very, very good company. So there are a few there. And that's actually a very good subject that I will cover in the next week or two's reports, because the overseas stocks are stocks that should be kept a very, very close eye on.
Okay. The next question we've got here is obviously from a subscriber who's had the service for quite some time. Shawn, you tend to trade relatively infrequently. Why is there not more buyers?
Good question. Well, if I owned a stockbroking firm, if I owned ComSec, I'd probably put a lot more recommendations out there and generate a lot of brokerage. What I'm trying to do is I'm trying to make money. And like a lot of things, 85% of the profitable trades will only happen in 5% of the time. So you just have to be very active and very focused for those opportunities. So that might well happen in the very short term. We might get a buying opportunity. But you don't have to trade that often. You have to be patient. Again, trying to sell tops, trying to buy bottoms is too hard. So don't trade too often. Be very, very fussy and be very precious of your money and take advantage of the opportunity when they're there. But it's all about preparation. When something gets close, get ready and act. Don't miss it.
Okay, another question's just come in from Casey. Now, she wants to know, is it too early to get back into mining services, companies such as RCR Tomlinson? Obviously, that space is a bit of a mess. Stocks like Bolt, Longyear, etc. I don't think you've gone into them at all in the recent.
Casey, I think it's quite funny that you're testing Nick's ability at pronunciation. Okay. Look, overall, it's too early. If I don't like the mining sector, why would I buy the mining services space? There are just better places to be, Casey. And I'm sorry. I hope you're not holding them, hoping they're going to bounce. It's not for me. I'm not interested.
Okay. As an extension to that, another mining-based question. Updated perspective on Rio Tinto. It's dropped below 60 today. Had a good run up to 64, 65 recently, but seems to be, a bit, downtrend again. What are you seeing there on the charts?
Well, I've been saying for a long time the chart hasn't really changed. The weekly chart, in this case, which is like the medium-term chart, because it's been a long term, it's just gone sideways. Rio's gone sideways for a long time. I think 75% of its revenue comes from iron ore. So you'd have to say the likelihood is it will reflect and move pretty closely with Fortescue. From an investment perspective, I have no interest in which puts me in the minority with a lot of money managers. I just don't want to be there because I don't have confidence about the iron ore price. At the end of the day, they are price takers. They're not price makers. They do not determine how profitable they will be. And you only can do so much cost cutting, and one has to feel they've almost finished doing that. So it's probably going to follow quite closely to Fortescue, but with less volatility. So when I'm buying Fortescue with options, maybe it's time to buy Rio. They might probably move together is my best guess.
Okay, awesome. All right, thanks a lot for that, Shawn. So for everyone that's watching, for more information on a Market Matters membership, or conversely to email us some questions, please feel free to contact us on the 1300 number, or conversely email info@Market Matters, and Shawn will endeavour to get back to you as soon as possible. He's usually pretty good with contacting people that get the service. I can vouch for that personally.
Thanks very much. And one thing I'd like to add, it's been a pleasure doing the first one. I'm sure we've done a few things around the edges that could be better. So any feedback would be really, really appreciated, because we do see this as way of the future.